Excellent. All right, let's get going. All right, thanks everybody for being on yet another Zoom webinar, and thanks to the 5 panelists we have here. This is a real hot topic. So we had 500 seats available for this webinar, and last I checked, I think we had 640 people that signed up for this. So there's a lot of interest in what these executives from these large DSOs have to say. So again, I'm Bill Neumann, and I'm with Group Dentistry now. I'm going to let George and Jake and Patrick and Grady and Greg introduce themselves, and then we're going to go into questions. There is a Q&A area. We most likely won't have time to get to any of those questions, but feel free to ask those. And if we happen to get lucky and we get through all the questions, we'll answer those during the webinar. If we can't do that during the webinar, we will do that after the webinar. And whether it's myself answering or any one of the panelists answering them, we'll make sure we handle that. So all right, so I'm going to let everybody introduce themselves again. I'm Bill Neumann, CEO of Group Dentistry now. And if you're not aware of our website, we have been producing DSO and group practice content since 2014. We have a free e-newsletter that goes out twice a month. Please sign up for that if you haven't already. And that's it for me. I'm going to let George introduce himself.
Hi, thanks, Bill. Thanks for hosting us. This is very much appreciated that you give us a voice here. But hi everyone, George Radigan with North American Dental Group. You know, all the info is right there on the slide, so no sense of me reading things to you. So thanks for having us, and looking forward to the discussion.
Thanks, George. And to George's point too, he's got his contact information there. The final slide that we have will have everybody's contact information. So if you feel the need to reach out to anyone, it'll all be in the last slide.
Thanks, Bill. Good afternoon, everyone. Good to be with you. My name is Jake Berry, VP of Business Development for MB2 Dental out of Dallas, Texas. And not to reiterate, but all my contact information and some stats on MB2 on the attached slide. Looking forward to today.
Thanks, Jake.
Yep, appreciate, Bill, everything that you guys have brought to the table here, and glad everyone can join. Greg Wappett, Head of Corporate Development at 42 North Dental, large Northeast-based DSO. Again, contact information there. I'd be happy to chat with anyone that needs to, but let's just keep this rolling.
Thanks, Greg. Patrick?
Thanks, Bill. Thanks for getting us all together. Welcome to everybody. My name is Patrick Costello. I'm VP of M&A for Smile Brands, DSO out of Irvine, California, about 450 locations.
And we have Grady.
Saving the best for last, right? Grady Wilson, VP of Development, Dental Care Alliance, over 325 affiliated practices in 20 states, headquartered in Sarasota, Florida.
Wonderful. Well, thanks gentlemen for joining us. We've got, so just to give everybody a little bit of a background on the questions, we crowdsourced these ahead of time because we had 5 panelists, realizing it's gonna be difficult to get through a lot of questions in a short amount of time. We may go over a little bit. So if you all want to hang in there a little bit after 3, that's great. If you can't, we'll certainly have the recording available so you can listen to it afterward. But let's get right into the first question here. So, and this is for everyone. We'll start with George. Do you anticipate any downturns in multiples? And this is a 3-parter. So it's currently, near, and future state. So George, you're the first one to tackle this.
Yeah, well, thanks. So yeah, I think this question is really what is on the forefront of everyone's mind. So to me, there is a lot to unpack here. So first, I'd start by saying that, you know, the volume of deals and the total enterprise value of deals obviously was impacted by COVID. However, I think that has been a long time coming. So I've seen Merger Market came out with a quarterly report, and this is for all US-based transactions, not necessarily just healthcare. And one of their findings was the volume and the total enterprise value of deals in Q1 has been the lowest in the last 3 years. So yes, obviously COVID did impact, but that came mid-March. And when you think about the life cycle of a deal, when you bookend a deal, the life cycle of something closing in Q1 typically doesn't start in Q1. That typically starts in Q2, 3, 4 of 2019, and then finally commences here. So yes, COVID did impact a couple of them or several of them for a couple weeks. However, it wasn't a full impact. So you could kind of see the wave coming where they have already been impacted. And then on top of COVID coming into the crisis here, there's several things, right? So most businesses, if not all businesses, are going to have a different focus. They're going to be focusing on the cash flow of the business, and then the operational infrastructure of the company. There's not necessarily an onus right now to start adding more deals into the mix. So, taking the deals off the table and reshifting focus to cash flow. The main other component here is the financing markets, right? So I've had the opportunity and the ability to speak with several folks that live and breathe and have intimate knowledge of the financing markets. So speaking with our partners, Jacobs Holdings Group, who have both an international and national intimate knowledge of the markets. Brian Castiglione from Jefferies, who banked our deal, this is something that he lives and breathes with every day. And there's really consensus opinion is that the debt markets are drying up. I mean, it's just a fact based off of reactionary to COVID. So there hasn't been a lot of debt issuances recently, if any. On top of that, you have the secondary trading market that buys loans and bonds has significantly diminished. And that's when you're expecting a 10 to 15% return off of buying debt. You have the CLO markets, who are really the main buyers of leveraged loans. They've had technical issues and they hadn't deployed any capital until recently. And then they have done several of them, but when they did issue the capital, it's at a 2x cost leverage of what they've historically done. There's been some recent deals, a couple recent deals, just US transactions that were much lower leverage. And that was with a unitranche loan, which is a combination of hybrid loan of your senior debt and your subordinate debt and a blended rate. And thinking about that, the cost of capital on those loans is more expensive. When you look historically, prior to COVID, we're paying 4 or 5% to borrow that capital, where now it's 7, 8%. And then adding even more into the mix, you have a pool of available lenders that is diminishing because of perceived overexposure, when you have some of these companies that are leveraged pretty healthily compared to EBITDA. So companies and investors are going to have to be more risk adverse. On top of that, they can't afford to continue to pay higher multiples, especially when there's heavily adjusted EBITDA. When you go into an environment when you're looking at companies that are leveraged 6.5 plus, and then continuing to take down debt, they're going to be quickly over leveraged, and that environment is quickly going to cease to exist because lenders are going to peel back a little bit. And then on top of that, your cost of capital is increasing. So there's a lot of uncertainty in the market that's going to continue for the remainder of this year and for the foreseeable future. No one really knows. There's no crystal ball if COVID's going to return in the fall or not. I mean, there's reports and likelihood that it may. So there's uncertainty there. And then when it really comes down to it, when you think of overall multiples, I always say there's really 3 main factors: is what's the cash flow of your business, what's the risk associated with your cash flow, and what's the availability of debt. So I don't think anyone can argue that the cash flow of all dental businesses is down. The risk associated with that cash flow is up, and the availability of capital is diminished and now more expensive. So when you tranche all those factors together, there's not a real healthy environment to continue paying 2018, 2019 multiples.
Thanks, George. Jake?
Yeah, I mean, well said, George. I think just to build off that, maybe a little bit more of an academic view on multiples. Certainly any buyer in this environment is going to be very mindful of their balance sheet and very disciplined around the overall health of the company. They'd be foolish not to. I do agree with the statistic around the dropping multiples. We saw that in Q1 ourselves. But when you think about multiples, just generically, I'll try to tie this to an individual dentist, that's looking to sell their practice. I think what commonly gets thought of is multiples are a function of how much cash flow is there, or how much EBITDA is there. So bigger deals get bigger multiples. But from an investor standpoint, the multiple is also a reflection of risk around the deal and to a certain extent, the growth potential. And when I say risk and growth potential, I'm talking about future earnings of the business. And so we're in a highly, highly uncertain period of time where risk is sky high and the growth potential of future earnings is questionable. So I would expect to see a pullback in multiples just based on investors not wanting to overexpose themselves or to George's point, over-lever their balance sheets. So I expect we'll continue to see M&A activity, but both for the near term and the long term, but certainly for a while, I would not expect to see multiples where they were, prior to the end of 2019.
Grady, do you have some thoughts?
Yeah, I do. I think all those are really good points. And what Jake was saying, I think leading up to this crisis, the combination of competition and predictability around growth of practices made it a hot market, to be candid. And I think as we look going forward, as everyone has mentioned, there's a lot of uncertainty around that. So that's certainly going to put pressure or impact how people are thinking about multiples going forward and the risk associated with some of these practices. I think we all hope and want this to be an extraordinary event that's never going to happen again. But I think to bury our heads in the sand and act like it's not happening, it's just not the right way to think about it. So I think as we go forward, recovery, how these practices bounce back once the lights are on, is ultimately going to dictate what the future state looks like. And, it's not to say that we can't get back to points that we were before, but there's a lot of uncertainty around how practices are going to recover, and we just have to see how that plays out.
Thanks, Grady. Greg?
Yeah, just to be quick, I agree with everything George and Jake said, and I think Grady kind of hit it on the head. The thing that we're most cognizant of is there's two aspects. There's one of which is how quickly our organization rebounds from this, because everyone on this call is in the same boat where we've all had to kind of shutter down and get ready for a period of time where we're not operational, and then we're kind of all mapping out what our ramp looks like. And likewise, all of our acquisition targets are kind of in the same boat, and no different than if 42 North Dental, if we come out of the gate and we're shooting it 50 to 60 to 70% of what we've been doing for months, January, February, and we're looking at the same thing for July, August, September, we're not going to be able to pay the same multiples that we were prior to. Likewise, our acquisition targets aren't valued the same. That's just economics 101. So I think everyone needs to kind of take a realistic viewpoint of where we see multiples going, and there's still a lot of uncertainty around it, but to think that we're just all going to to Grady's point, to think we're all just going to stick our heads in the sand and value everything based off of a February 2020 TTM and call it a day is just it's just not correct.
Anything you want to add, Patrick?
Yeah, I think George and Jake, you guys brought the data, and that's the real answer. And I 100% agree with what you're saying. The only nuance that I might add to this discussion is that I think multiples up front will certainly decline faster. And there may be a mix shift in the way that we talk about deals and have more deals with more equity that the doctors hold post-closing, more earnings like that. So while your upfront multiple may not be what you're expecting to get in the 2008, 2009 time period, there'll be good deals to be had. People that have equity can own more of their company going forward, and their people will have teeth, and people will continue to have need for dentistry. And these companies are going to be around. All these companies at this table are around for the long term. So being able to invest a larger percentage of your practice back with a big partner may actually be useful in the future, and maybe some of the changes here.
Thanks, Patrick. So next question, as we have a lot of them, has the valuation of larger DSOs been affected by COVID-19? So I know that there are we've got a real mix of attendees. We've got people like yourselves from large DSOs, and we have a lot of solo practitioners wondering, where they stand. But let's talk about what you all are seeing, and we'll start with Greg on this one.
Yep, it kind of goes back to the point I just brought up a minute or two ago. I mean, look, if you were to look at 42 North Dental on a TTM basis of February 2020, we would be valued at X. And to think that we could be valued at the same point come June TTM of 2020, that would just be unfair. I think there's a lot of uncertainty of what the next few months play out to look like. So if we as an organization, if July and August and September all look like January and February, and we can find a reasonable solution to write off essentially this 3 to 4 month impact, then it wouldn't necessarily overly impact us. The reality is, look, we're all looking at decreased patient volume. We're looking at increased PPE spending. We're looking at decreased efficiency of a per patient visit from a hygiene and dentist appointment. We're all looking at staffing measures and how much staff is going to come back, how many patients are going to come back. There's a lot of uncertainty to go through with it. So I'd say right now, like any large DSO looking to transact right now, it would almost be a little silly, because no one really knows what kind of the new world looks like. There's a lot of speculation going around with it. It's a lot of guesswork. We're on the phone on a daily basis with our executive team trying to figure out how this all plays out. I think we all feel very confident that we're going to come out of this in the back end feeling very well, but in the short term, this is going to have an impact on us. And to the second point of the question of how does it trickle down to other practices and group valuations, it's, the same questions apply to them. What impact do they feel on this? We can source a lot more PPE than a smaller group or an individual dental practice can. We can ramp up a lot quicker than smaller dental practices and groups can. And how does that play into valuations? To Grady's point earlier, or to Patrick's point on the back end as well, like it's just going to result in, if people are looking to transact and looking to partner up, it's going to result in being a little bit more strategic and a little bit more thoughtful of how we structure transactions, where we kind of share a little bit of the risk of how this all plays out in the long term.
Grady, anything you want to add to this?
Yeah, I think said a different way. I think those that were going into the crisis strong will come out of the crisis strong too, if they've taken the appropriate steps from an operational standpoint. I think it's hard to say that larger DSOs aren't going to be impacted by this, and that wouldn't trickle down to the practices. I think you're not seeing probably a lot of larger DSOs line up to transact right now. And I think Greg was mentioning that. So I think there's a wait and see period. I think the strong DSOs will come out of this and recover hopefully quickly, and can get back to a point where they're crown jewels and really valued assets. But ultimately what that time frame is to be determined. And the same questions, not to be repetitive, but they have to be asked of smaller practices and groups as well. If DSOs aren't valued the same right now, or their values impacted, well, certainly that would impact people further down the chain too.
Thanks for the input, Grady. Next, let's move on to this next question here. It looks like we have all of you wanting to give your input, which is great. So big question, a lot of solo practitioners, some of these small groups, they all want to know when you're going to start to acquire practices again. So George, you can start this one off.
Yeah, I mean, the short answer is we're going to start acquiring before anyone else on this panel, so call us first. No, I'm kidding. The reality is, I think it's case by case specific. So when you have to look at each group, each DSO, and really who the backing is of each group. So we have a well-capitalized backer partner with Jacobs that does not have a multitude of multi-site healthcare exposure, where there's certain groups that may have PE backing that really took it on the chin during this time, and has a vast portfolio of physician-backed healthcare practices. So it's really just dependent on that a lot, alongside with how did they respond? How did certain groups respond to the COVID crisis? Where are they? How is their balance sheet? How much capital do they have on hand? Have they stabilized operations? There's a mixed bag in all of it, honestly. So some sooner than others, but it really just depends on appetite. And like I said earlier, it's not something that's on the forefront of everyone's mind right now. It's really, let's stabilize the operation. Let's get our people back to work. Let's get the foundational parts of the business stood back up, and make sure that our doctors, our team, and everyone is safe and has the proper PPE and can facilitate the patient flow through that they need to do to get back to normalcy within revenue. And then once that's established, do you have the access to capital, and with, again, not to beat a dead horse, but with some dried up financial markets, and is your partner, your sponsor, willing to strike a check to help you out if needed to continue growing the group? And I think that's a mixed bag for everybody. I mean, we're continuing to stay active right now, and but we're in a very lucky, very fortunate position based off of timing of our deal when we partnered with Jacobs last October. So we're lucky. I know everyone else on this panel is in a really strong position as well, but it's kind of a mixed bag.
Patrick?
I think George hit the nail on the head when he's talking about it's going to be very secular depending on each individual business. I can speak to our experience. Fortunately, with our size and scale and access to capital, we've been able to maintain at least some presence in every single one of our markets and keep some cash flow going. But the first and number one priority right now is protect the balance sheet and make sure that the company's there long term. As we've come out of this and got more and more of our practices operating, we started to look towards the future. You really have to break down the types of deals that are going to get done and when. We're already looking at smaller transactions than we normally would look at based around relationships, or if there's a dentist out there who is in the older vulnerable population, we've had a relationship for a long period of time and wants to talk about a practice merger. We've been looking at those types of transactions already and hope to announce some of those soon. And a lot of that's coming from the fact that we've been active in these markets through this entire crisis. Once to get back to the full normal where we're doing group practice acquisitions and individual offices, that's going to be a lag behind getting our company back to full health, as George said. But we're active out there, and for us, as we come back to our pipeline, it's really going to start from what are the strongest offices, what are the ones we have the longest, deepest relationship, where we know the culture matches best with what we're doing. And then after that, we'll start to look more deeply into, hey, it's not just what your revenue is, it's not just what your EBITDA was before close, it's what is the true deep relationship and goodwill you have in the market you operate that's going to mean that you're going to be the one that comes through the strongest, and that's who we're going to prioritize when things back open up.
Sounds good. Jake?
Yeah, probably ditto to both of those. I mean, the capital availability is a big one, and similarly, we feel we're in a good spot there. We have a strong backer in Sentinel Capital, and all our doctor partners, individual dentist doctor partners, are themselves all capitalized and willing to bet on the business by bringing capital to the table. So we feel like we're in a good spot there. But I'm sure everyone's going to say this: no one wants to act reckless during this time. We want to get back to acquisition mode as quickly as we can, but we're not going to put the whole group at risk just for the sake of doing deals. So there's no calendar date we can put on this. It's not going to be an arbitrary timeline. This will be very much conditions driven, where we're assessing each opportunity and partnership we have in our pipeline, observing them reboot from the shutdown themselves, getting their business back to some state of normalcy, because the last thing we want to do is acquire or make an investment in a falling knife. So for us, again, it all goes back to risk. And as we start looking to deploy capital during a very uncertain time, just mitigating our risk the best we can and placing a priority on execution and risk mitigation over speed to close.
Thanks, Jake. Greg, you have anything you want to add?
Yeah, the only thing that I would add, I look at this in two buckets, and I agree very much with George, Patrick, and Jake on the concept of the financing and some of the challenges that we're all looking at, and very much so the relationships of the individuals that we're looking to partner with. I think the second aspect of this that shouldn't be lost is everyone on this call, from a DSO perspective, look, we're support organizations, and we need to be able to support our offices. This isn't just a game about buying practices for the sake of buying practices. So it would be unfair for any of us to start acquiring practices when some of our home office may still be furloughed or is dealing with all of the other ramifications of supporting our same store offices. We just need to make sure that we're in a position that we can really support our offices the way that we all want to, and the way that we all have kind of hung our hat on, of being able to be successful in the industry, which is a huge value add. I think a lot of private practices today can kind of look at the DSO market and think, wow, I really wish that I was part of someone else to deal with a global pandemic, which none of us obviously predicted, but these are the things that come up, and these are ways that being part of a large organization has a lot of benefits to it. So before we start adding practices, the financing thing is one aspect of it, but it's more to us too. It's also the aspect of, are we ready to support those practices the way that they want to and deserve to be supported to be part of the organization?
Thanks, Greg. Grady?
Yeah, I would echo a lot of that. What I would say from our perspective, though, is we haven't taken ourselves out of the market. We're actively looking for best-in-class practices to partner with. Now, I'm not going to be disingenuous with what's going on. So we are looking at longer timelines to close as practices are recovering. But I think that's a testament to, one, our partners, Harvest partners, who have given us the full vote of support, so to speak, that our business has been impacted, but I think we've weathered the storm pretty well. And so with that, we want to continue to look for great partners. And I forget who mentioned it, but I do think this really is a catalyst to think about for people, that in times of prosperity, it's great to have a partner, but certainly when things are challenging or there's adversity going on, having a partner, having that organization that can support you, that size and scale, is really impactful. And knowing that you're not on your own, that you have a partner to work through it together with, has been certainly a benefit for some of our recent affiliates.
Thanks, Grady. So I know most of you addressed this specific question earlier on, but how long do you think, so what's the prediction here, if you can predict it, the valuations of dental practices will be affected? Is it 6 months? Is it a year? Are we 2 years out? I know, take out your crystal ball, George, if you can, and give us a little insight.
Yeah, it's a great question. I think when you look at just valuations in general, just take dental out of it, it's going to mirror the macro economy. So when, look at the stock market, how's that performed this year, and what's the onset of that? And then, with all these people out of work and some industries that are heavily distressed in getting back into it, it's going to follow the macroeconomic part of it. And it's definitely going to be for the foreseeable future. I mean, for sure the rest of this year, and it's definitely going to bleed into 2021. And it just really depends, again, on the availability of capital and what the credit markets look like, and what the overall state of the dental economic environment is reflective of.
Anything you would like to add, Greg?
The only thing I do have to unfortunately remind George of is, if you actually look at the public markets, it's an unfair comparison, because January to today, you'd be almost up. You would actually be up. So that one's a little bit of a tough one. But I do think in the overall, if you think about it overall, like, all of the buyers are being impacted on this. And likewise too, there's going to be a lot of mid-sized and smaller buyers, including individual dentists looking to buy practices that are going to be financed by your Bank of Americas, your Citibanks, whatever the individual lenders are for individual dental practice acquisitions. They're going to be hamstrung a little bit. So the competition is just going to go down. Now, at the same point, we feel very strongly that as long as the overall industry rebounds, as we hope it will, and as we all kind of are anticipating it will, and we're making a lot of investments to make it do so, it's not to say that the valuations are going to go down in the long term, but people do need to be realistic about what does that look like from a structure perspective? Are you going to get that all up front, or does it need to be kind of back-ended a little bit? Are people going to be willing to stretch? If I look at the deals that we had under LOI prior to this, anything that was heavily stretched on a valuation perspective, we're a lot more suspect to be talking about valuation hits versus valuations that were reasonable and within market. We have a little bit more room of flexibility to kind of continue those valuations to a closing point when the time is right. So it's there's a lot of moving parts to it, but absolutely thinking that the valuations are going to be impacted without a doubt. There's no doubt about it. But does it mean overall valuation, or does it mean structure and the timing of the payouts of these things? That's a little to be determined, and it very much is dependent on the buyer and how quickly they rebound and their ability to finance these things, and also the sellers of how quickly their practice is actually able to rebound and showcase that they're worthy of the valuations that they had received, 6-9 months ago.
Jake, anything you'd like to add?
Yeah, I'll maybe tack on one comment just from like the individual dentist owner looking to sell their practice. I completely agree with everything George and Greg said. That the underpinning of valuation, as we've talked about, is the earnings of the business, right? Specifically, trailing 12 months. That's how every private business is valued, is off their trailing 12-month earnings. And so when you think about that on a go-forward rolling basis, you have 2 months that have become a black hole, and probably more. So, again, kind of an academic answer is it's going to take a year for this shutdown period to roll off the book, so to speak. Now, by end of the year, do buyers feel like they have more confidence and a lot more clarity into how to evaluate an individual acquisition target? Yeah, maybe if there's been a strong rebound and predictable kind of run rate view. But again, subject just to the way the credit markets will respond, I think you're going to see a much less willing buyer base, or a buyer base that's much less willing to stretch and make grandiose assumptions to get somewhere on a valuation.
Hey, Bill, could I hop in there for a second?
Yeah, absolutely.
This is Patrick with Smile Brands. So as Jake said, valuations historically, they're all based around the last 12 months worth of cash flow. But the moment the deal closed, the valuation, the buyer only really has any value from the future cash flow that comes out of the transaction, right? All that history, all that LTM, all that cash that was generated for the last 3 years from your practice, if you're a doctor, is sitting here in your bank account, your MB2, your Smile Brands, all that we benefit is the cash flow in the future. So when the future is this murky, I think that's why we pull back valuation a little bit as a risk mitigant, but we're also willing to think about how do you share in that future cash flow. So if it's a V-shaped recovery and everybody jumps back into the dentist and within the first year there's just as much cash flow as they're going to be, then your valuation should have been similar to what it was before, but there was no way to know that going into it. So we're starting to look at a lot of creative structures around earnouts and things like that that say, hey, it's a risky environment. If it's the worst case, you're going to feel a little pain with us. We're going to be in the same boat. But if there's a V-shaped recovery and things grow really fast and us as the buyer actually got a lot more cash flow than we anticipated in that multiple we provide you up front, then we'll share that with you. And I think you're going to see that from everywhere around the table, that there's going to be a lot more risk sharing, because when that's the primary purpose of an earnout, is to say the future is uncertain. Seller might think there's going to be V-shaped, buyer might think it's going to be U-shaped. Let's come together and come up with a structure that means that there's a win-win if things go really well, and there's shared pain if things don't go as well in the recoveries.
Thanks, Patrick. So let's talk a little bit about the value of retained equity? Is it important? Why should a solo practitioner, somebody that's looking to sell to a DSO, what does that mean to them? So talk about retained equity, explain it maybe to the folks that don't understand what it is, and let's talk about the importance. Jake, you're up first.
Yeah, so I'll talk about this from the MB2 perspective. I won't speak for anyone else here. I know there's all sorts of different equity structures in the marketplace today, but I think what a lot of dentists have seen and become more educated on over the last couple of years is the varying options of deal structures that are out there, which generally include a mix of both cash and equity. And I think it was Patrick earlier on this call who talked about, retaining equity for the long term is really having some upside value for the dentist. And I would completely agree with that. I mean, in this type of economy and this type of environment we're in today, if you're a dentist and you believe in the fundamentals of your business, or at least the long-term fundamentals of your business and the long-term fundamentals of the profession and the industry, retaining equity is a great hedge against an otherwise uncertain marketplace. And I think we all at least hope that the market will rebound over time. And so if you're a dentist looking to sell today and you feel like you're entering a market with depressed valuations, retaining equity still gives you future upside and the ability to capitalize on the business that you're going to continue to grow, build, and take into the future. So it's something that shouldn't be overlooked. And I'm, for the last point, you're going to see a lot more deal structures out there. Buyers are going to have to contemplate, more creative deal structures. Within the MB2 model, there's always a practice level equity component. As a group, our doctor base, our doctor partner base, our CEO, who's our founder, all take the long view on the business. This isn't like a 2 to 3 year outlook on things. So I would encourage any dentist out there not just to get fixated on where multiples are today, and think about how over time they can monetize and achieve liquidity out of single most valuable asset that they've spent a lifetime building. So that's something we always stress, and I just think that's, in this environment, something very much that should be considered as a risk mitigant too, if you're an individual business owner.
Thanks, Jake. George?
Yeah, I agree with that. I mean, it's pretty basic. I was trying to numbers, right? And when you look at collectively, we
I think we're having trouble hearing you, George. It's not just me, right?
Yeah, no, that's bad.
All right, we're gonna jump to Greg, and then we'll see if we can get George from being Darth Vader.
I agree with Jake. I think, looking down the list of, the folks that we're on the call with, I think all of us have different sort of equity structures. And, similar to Jake, I'll just kind of speak from the 42 North Dental model as opposed to others. The way that our equity structure works is anyone that sells to us, they become equity holders in parent company. So we don't have any practice level equity situations going on. And what that means to our shareholder base is they rise and fall with the tide of how the overall organization is doing, not just the individual locations. So even just looking at something as absolutely crazy as a global pandemic, which forces, I'm assuming everyone on this call shut down offices and went into certain hub type models and everything. Anyone who is a shareholder was fully on board with that, because it meant that it was the overall protection of the organization, not just the overall protection of their individual practice. And that's just like a pandemic situation. But even going forward, anyone that's a shareholder in the organization and that partners with us, they get the upside of everything we do. Every new practice we affiliate with, every new location that we build from scratch, all of the growth of the individual locations that we've been part of for 40 years or 2 years, they get the upside benefit of that. And there's very strong equity return models in that. So exactly to Jake's point, sellers need to think about more of the long game as opposed to the short game. There's one thing to get a check at closing with a bunch of cash that you can stick in the market. There's another thing to actually have ownership in a model that you believe in, that you're going to be part of for whether it's 1 year, 5 year, 10 year, 15 year, that is going to create equity value behind the scenes for you. And being a partner of an organization, especially when crazy things happen like COVID-19, you're more than just an employee. You're a partner. We've had bi-weekly conversations with all of our partners to make sure that they all understand every step of the way what our organization is doing to protect their equity value, to protect the organization, and to ensure that we all have an organization to come back to and is going to flourish once we kind of come out of this. But it's kind of a one for all as opposed to kind of a spread out organization or a group of employees. Everyone has kind of a different way to skin the cat, but that's kind of the way that we've done it. And we've got a lot of equity holders that all of our equity holders are very proud of being part of that sort of construct where they're not worried about their individual office. They're not worried about just them. They're thinking bigger picture on the total company, which has been very helpful for us.
Grady, you have some input on this?
I do. I would say retained equity is embedded in the DNA of our organization and what we do. The way we like to think about it is we want partners both at the local level within their practices, but also within our broader organization, what we call Holdco. And the reason why that's important to us is we want alignment. We want our incentives to be the same. And so as we're rowing in the same direction, our partners benefit from that. And so I think it's important for people to have skin in the game. I think it's important for, I think the psychology changes for people when they're still an owner versus if they become a 100% employee. And so for us, I think our structure is unique in that it allows people to still have upside, both at the practice level as we're able to build and grow and unlock value with them, but also within the organization so that they are thinking about something beyond themselves. How can it benefit DCA as a whole? And our structure, it allows for both of those things.
George, you want to try it? Give it another go?
Yeah, it's better.
No.
Yeah, a little bit.
All right. It's okay.
Yeah,
All
on
right.
the last one, I didn't get a chance to weigh in here. It's Patrick.
Oh, hey, Patrick. Sorry about that.
Yeah, so without giving any sort of Smile Brands commercial or anything like that, I think that the good thing for everyone that's called in knows that in tough times, contract starts to fail. And what really matters in a partnership is the culture and how they make their decisions, how they operate as a company. And so in this time period, when you're thinking about doing a deal with lots of equity holdback, lots of earnouts, doing what's called reverse diligence and making sure you know your partner is going to be really, really important to any dentist out there thinking about selling. For us, we want everybody to look at our culture, our Smiles for Everyone. I'm sure each of the 5 members on this team, they have a very distinct culture, and all the organizations make decisions differently. And it's really important to get in there and meet those folks that are going to be your partners, because the next thing may not be a coronavirus. It might be just a normal standard recession or something else, who knows? But when things go tough, the contract goes out the window and it comes down to who are your partners and how are they going to treat each other. And I think that's important for everyone to think about.
Thanks, Patrick. So you had some practices, some groups that you've been working with, some that you may even have LOIs out, some that maybe just targets that you're talking to pre-COVID and still continuing to talk to. Let's talk about some points of frustration that you're hearing from some of your longer term targets. And I guess I don't know if we can go to George or not, but why don't we start with Jake, unless George is brave enough to give it another try. That's a no. Okay, Jake.
Okay. Yeah, I mean, some of the points have already been hit on. I think one of the things we've noticed the most of is just a general frustration at the inability to decipher the mixed guidance or the lack of guidance or the conflicting guidance that comes out from, state and local government, state dental boards. It's just very confusing if you're a dentist trying to figure out, when can I open? What can I do during the shutdown? What rules do I need to abide by? What can I do when we reopen? And so I think as a group and as a partner, the one area of value we can really add to that is just by actually deciphering the guidance and publishing that to our partners in a way that adds clarity to an otherwise uncertain situation. That's definitely probably one of the first and foremost things we've noticed. Access to PPE has been touched on. That's a big one. Obviously, dentists want to get back to work, and having the protective equipment or access to the protective equipment has been a frustration for them. I think on a more intangible and kind of financial related point relative to this specific discussion, though, has been the understanding or the realization that as a business owner, as a solo business owner, you know, a substantial amount of your personal wealth is in a very illiquid asset. And so understanding, you know, the value in a business and the value that a partner can unlock, both in near-term cash and long-term equity value, I think has been a very big realization for a lot of dentists who have just kind of been sitting on the fence for a while, figuring out what they should do with their business.
Thanks, Jake. Greg.
Yeah, I agree with everything Jake just said. I think, you know, the PPE, it shouldn't be underrated. I've had, and I'm sure everyone on this call has had multiple conversations with individual practice owners that they are struggling to think of how they're going to be able to reopen their practice, and even get their hygienists back in and be able to get to a normal course of business with the amount of PPE they're able to obtain. The reality of being part of a DSO is we've been working on this for a month now, and it's not like it's a hoarding situation or anything like that. We're just, we have the ability, all of us on the call have a better ability to obtain this sort of stuff than individual locations. And we have the ability to distribute it amongst our locations. I think one of the big things that definitely shouldn't be kind of forgotten about is even just the handling of employees throughout all of this. You know, every individual dental practice throughout the country probably furloughed all of their employees, but what sort of information were they able to give them about how to apply for the appropriate benefits and all of the coverage that the government was offering? What sort of information were they able to give them besides just kind of telling them to go Google it and figure it out on their own? You know, I'm sure everyone on this call, I know that we have a full HR team that was working around the clock to make sure that every unemployment benefit was, you know, applied for and achieved, and that all of our employees understood that they still had a home to come back to. We kept their insurance running. You know, there's a lot of different little things that larger organizations were able to bring to the table. And then just overall kind of even just patient communications and just overall workflow coming back. As Jake said, the questions, especially on a state-by-state basis, it differs depending on what state you're in. Being able to confirm with your employees, to confirm with your patients that you're safely able to operate, you're safely able to see your patients, you're going to obviously adhere to the strictest adherence to safety precautions and PPE precautions and everything for both staff and patients. But those are things that we can bring to the table as DSOs because we have a lot of resources behind the scenes that are working to make sure that we know all of the details. Where individual practices, I've fielded lots of calls but from people asking us, can we just send them our internal communications on these sorts of topics because they want to know what we're thinking? And that's a tough topic. Like, it's one thing if you're thinking about selling your practice and joining us, but part of being part of a DSO is you get access to that sort of information. And it's tough to kind of, you don't want to obviously withhold it from other people, but at the same point, those are the benefits that you get from being part of a larger organization that has the resource to really put the time and effort into making sure that we know exactly what's going on and can distribute that to all of our team members.
Yeah, I echo a lot of what Jake and Greg were saying earlier. Our CEO, Steve Bilt, and our Chief Dental Officer, Robert Krim, they take it very seriously, the industry leadership position that they hold as being one of the largest companies in the industry. And so they've taken it upon it to really be radically transparent with all of our efforts. You can go to smilebrands.com/COVID-19 and get access to all of our internal protocols and the different placards we're putting in the doors and their patient flows. And then for folks that are within the company and then folks that we've talked about joining, we've included them in all of our internal communications, including bi-weekly sort of Q&As direct with our CEO, which, God, I'm glad I'm not him when I'm sitting there getting questions from people that are furloughed and questions from hygienists wondering if they're going to be safe. But they've done a great job trying to lead us through this. And I think I think the important takeaway I'm trying to make here is that when the industry is healthy and when all dentists are healthy, then Smile Brands is healthy. And so we really want to make sure that everybody is doing the right thing, and we're using our resources to help everybody as much as we possibly can. And hopefully that'll develop some community goodwill and maybe help us in the back end.
Georgie, try one more time.
Yeah, so I switched to phone audio. Is that better?
Yeah, it's
That's
great.
All right. Yeah, so I agree with everything that you guys are saying. I'm going to take a little bit different angle on this. So yes, like I think, DSOs have showed just strength in numbers here with the help of the ADSO, and I know Ken Cooper, our CEO, is an active, on the executive board there, and I know that the ADSO members are in constant communication with each other and just really sharing best practices, which collectively makes everybody better. Protecting everyone's doctors and staffs and teams and all that. But from at least a more, I guess I don't want to say selfish angle, but the things I'm hearing right now is, the people that we're engaged with, they have strong practices, they have strong groups, and the product of the environment here is that, as we just talked about ad nauseum, is the environment of lending and capital and valuations and things like that. And what's giving them heartburn is now the right time? Should I partner with a group right now, or should I wait till I get on the back end of this crisis? Will valuation swing back around? And I think that's, the impetus of us even having this call. And, luckily with the way we have things structured, and to go back to the prior question with the partnership model and how we have enterprise, holdco equity, and everyone's in one boat rowing in one direction, is, the good news is that, the strength in numbers, and you can collectively grow your equity and have a very healthy material compounded return upon your investment in the company. And that will eventually, get you to a much higher net worth or valuation collectively as a group than you would ever be able to do as an individual. And it's really just from a pure financial perspective, is now the right time for me, because, I'm sure all my colleagues on the phone here will agree that if they're engaged with us on conversations to enter into a conversation, then they've already made the decision, and it's really just a product of what group do they fit in best. And Bill, I know you and I have talked about this before, but all of our groups are common theme at the end of the day. It's really just how do you get there, and what's the best culture, and where's the best fit for you. And that's really, to me, is now the timing right, considering all the moving pieces and parts.
Yeah, good point, George.
So could I touch on
sure,
that
Grady,
quick?
go ahead.
I just wanted to say, and again, don't want this to be repetitive, but I think we've taken an approach where we want to be a resource to whoever we can out there. And so much like others on the phone, we are sharing daily communications with potential partners, even people that we haven't even been in conversations with that long. And I think what this is showing them is the resources and the breadth of our organization and what comes along with that. I think a lot of times people get focused on valuation and structure and how much cash at close they're going to get, but this is showing what it's like to have a partner. And I think people are getting a test run at that, and they're feeling more comfortable of saying, okay, if this was to happen again, having a partner alongside, look at all the resources I have, whether it's procurement or HR or compliance. There's a new environment that people are living in as they're trying to open their offices back up. And so I think just being that resource to people we've seen a lot of positive feedback from that.
Thanks, Grady. Well, so we've got a bunch more questions, plus we have at least 15 audience questions, which we're not going to get to everything. So I'm going to jump forward a couple questions, if it's okay with the panel, so we can hit on a couple that I think are really important. And then for anybody that we haven't been able to answer questions, again, we will be able to save all these questions, and the panelists will be able to get back to you for sure. There's some really important questions that we're not going to be able to answer. So Yeah, this one real quickly, we'll go with you again, Grady, since we have, I mean, are you evaluating any opportunities differently because of COVID-19? So just, real brief, what are your thoughts on that?
I would say we're still looking to partner with best in class practices. That hasn't changed for us. I think what has changed, and it's been talked about a lot on this panel, is the environment and the economic impacts of that. And so for us, we still want to partner with great practices, great people that have good brands and reputations in their community. And what we're trying to sift through is, how do we structure that so that neither buyer or seller is disadvantaged? We want people to feel good about these partnerships. We want them to be walking into something. So what type of mechanisms can we put in place so that if the practice recovers, then they get back to a structure that they feel good about and they're not leaving money on the table?
Thanks, Grady. Patrick, you have anything you'd like to add?
Yeah, I mean, it's remarkable. I was looking at my notes and speaking to our leadership team before this call, and our messaging is the same as it is in good times and bad. Culture is important. The one thing, if we want to just skipping over sort of the EBITDA and other conversations, I think it just adds a lot of variability. It may make us a little bit slower in the diligence process. We really have to get to know the practice a little bit better, right? So, if you're looking at EBITDA, it might not recover for some period of time because you have to evaluate, is there enough room for there to be social distancing? Is it a horseshoe or is it a hallway where you can't figure out a way to have a one-way? Do you have to have smaller number or larger operatories? So we're going to have to look at all of the practices we evaluate slightly different. And we're focused not necessarily on the past, because the past is the past, but trying to evaluate in that one office, how is that going to perform in this new normal environment? So that does make everything look a little different, but the fundamentals of what makes a great practice haven't changed. The fundamentals of what are the cultures that align with ours haven't changed. But the numbers and the detail of diligence is going to have to be a little different than it was in the past.
Thanks, Patrick. What we're going to do is we're going to try and take this to 3:10 and no longer than that. So I jumped ahead a couple questions here. I think this one's important, and this is really for the solos as well as the other groups that are on the webinar here. But any recommendations in regards to preserving practice value right now in this environment, and then maybe as you start to ramp up and open up practices again? We'll start with George.
Yeah, this is a great question. I think there's two main components here, right? So the first thing is making sure your team, is comfortable and feels safe coming back to your office environment, considering, everything going on right now. So, you have the opportunity right now to control the narrative and take proactive measures within your practice in order to make them having, the maximum amount of comfort coming back to treat the patients and make sure that they're happy and maintain, good health while doing so. So, there's all sorts of, additional CDC regulations and advanced PPE, and Dr. Matta and our advisory board, as we've talked about with the other groups here, that done a really good job of not only hitting the CDC guidelines, but just going well above and beyond that, which then gives a big relief, collective sigh of relief to the team coming back, that they know they're going to be safe doing their job and that they're happy to come back. And then the other big thing is, listen to your patients. Historically, dental practices have had pretty cushy hours, and we are in the healthcare services field. And when all these people that are either furloughed or unemployed start going back to work, the last thing they're going to want to do is take time off to go to the dentist. So, adjust the hours of your office, and, no more banker's hours, and keep it, weekends, evenings, mornings, accommodate the patient as much as you possibly can in the interim future to keep them coming back through the practice where they don't have to, have a big detriment to their professional life after they've already incurred, a massive loss during this time.
Greg?
Yeah, I agree with everything George just said. I think just to add on to that, I would say, investments that you can make, I guess it kind of depends on if you're looking to transact in the short term or in the medium term. Either way, I think investments made into ensuring that your practice has taken the appropriate steps to follow by the guidelines that whatever your your state or whatever the ADA is kind of supplementing there. I've had a lot of conversations with folks that are investing in a whole lot of air filtration systems, kind of revamping the way that their protocols work. A lot of it stems upon the team. We as an organization, we haven't really seen that much of a dip of patient desire to come back to the office, provided that we're able to give them the sense of security that they need. So, you pull up to the door, but you sit in the parking lot until your name's called, little things like that. And as long as you're able to continue, kind of continuing to see your patients, but at the same point too, preserving your practice value, at the end of the day, it's also going to come down to a lot of the financial aspects of it. Are you able to get to the productivity levels and the financial levels that you were prior to all this? And that, to George's point, we've got practices that they want to open 7 days a week now because they know they're going to have to stretch out patient visits to certain extended period of time. And that means that people are going to have to work longer hours to see all their patients. And that's how you start to get to those sorts of levels. It's not just going back to business as usual and you see a 20 to 30% downtick of the number of patients you can see with an increased cost of seeing every patient, because that's what you used to do. You're going to have to make some changes along the way.
Okay, thanks, Greg. Jake?
Yeah, a little bit of just seconding what both George and Greg said. I mean, this is, there's going to be winners and losers out of this in the local dental markets, right? In difficult times, I guess maybe it sounds a little cliche, but difficult times require leadership. And so if you're an individual dentist practice owner, I mean, leadership is the most important thing you can bring to the table. Clinically, operationally, financially, you've got to be a leader for both your team and your patients so you can emerge from this as a winner. On a maybe a more practical level, if you're in that spot where you're more near term looking to sell your practice or pick a partner and you're trying to recover value, the one thing that we've been telling future partners and prospective partners is focus on what you can control. You can't control the credit markets. You can't control what buyers are going to do, but you can control your schedule. You can control getting patients in the door. You can control your flexibility and responding to what the patients need so you can drive new revenue, new production. That's all well within your control. Same on the cost side of the coin. Like, focus on the costs you can control. Like, rent is what it is. Let's just face it. But other day-to-day operating costs, like if you're not close with your numbers, you should get real close with your numbers, like over the next few months. That's going to be something that's well within every dentist's control and something they can influence in an otherwise a period of time where there's so much beyond everyone's control here.
Thanks,
Hey,
Jake.
Bill.
Yeah.
Can I make a quick point? It's nuanced, but I think it is important. I think some of the ways I've seen dentists utilize technology to still engage with their patients throughout this crisis has been pretty cool to see. And I think that's impactful for preserving value of the practice, because as much as they're still teed in or cued in with their patients, whether that's on the orthodontics, general side, whatever it may be, those people still feel like they have access to care, which I think as this thing plays out longer term, that will be important for them from a stickiness standpoint within the practice. So I think utilizing different means of technology and how you engage with your patients is an important thing to consider as well.
Thanks, Grady. Well, we've got about 3 minutes left, so we'll finish up on this question here. So, and then again, the Q&A, we've got at least 18, some more in the chat, so we'll make sure we get back to everybody on those. Creative deal structures. So yeah, let's talk about that, Patrick.
Love deal structures. I've been speaking about it throughout, so I'll kind of forget about what I've already said on earnouts, but another structure I want to talk about is I think there's going to be a lot more practice mergers, and sort of chart buys is the old name for it. You've got stats that I've seen anywhere between 20 and 25% of independent practices may never open. A lot of that's due to early retirement or doctors that are, just go bankrupt or whatever else that happens. Fortunately, DSOs, large DSOs like ourselves and the others around the table here tend to have a younger demographic doctor base, tend to have larger practices, And so I think we're going to see a lot of older docs merging their practices and trading their patients off earlier than they expected to younger docs that are able to get back to work earlier and safer. So I think that's an interesting structure to follow. We've been doing that for years. I say that we, the Royal with Decision One Dental, our partners in Chicago, have been doing that for a long time. So we're learning from them how to do that best in the rest of the country. There's a ton of Q&A on there. I just wanted to mention, I couldn't let us get off the call without hearing EBITDA C for coronavirus.
I like that.
We've been throwing that out as if it means you're going to throw away the 2 months of EBITDA and just get back to the old level. EBITDA C means EBITDA, but now understanding that you're going to have higher costs for PPE in the future, lower throughput because of social distancing guidelines, and it may take a while to normalize. So when I think of EBITDA C, there is an EBITDA C, but it's not some magic wand that gets you back to where you used to be.
Great. It looks like you're the last one here. So why don't you, anything on, and actually we'll let everybody answer this since this is the last question. If anybody has any input after Grady, any creative ideas?
Yeah, I think it's a mixture of what everyone has already said. I think we're looking for mechanisms so that people have the ability to earn back or get to the point of where their practice was pre-COVID. So someone talked about an earn-out. I'm actually coining the phrase earn back. That could be through retained ownership. That could be through some type of contingent note. We're still in the process of looking at a lot of different avenues, but like I said before, we want to have a structure so that neither buyer or seller is disadvantaged. We want the pace and timing of recovery to ultimately dictate what that final valuation is for our partners. And so we'll continue to look at how we can be creative on different avenues going forward.
Thanks, Grady. Anybody else? Any final thoughts? Wonderful.
Bill, just no final thoughts on that. I just wanted to, thank you and Kim for hosting us here and everything you guys do for the DSO world. And, I know I speak for everyone here that we really appreciate everything and this has been great. So thank you very much for having us.
Sure. Absolutely. Thank you, George and Patrick, Greg, Jake, Grady. Obviously contact information. We'll have a recording of this. And with all the questions that we've had, we may actually want to bring you all back, and because we probably have another 3 webinars here with just the questions. So don't be surprised if I ask you all to come back. But thanks again, and thank you everybody for hanging in there for over an hour and 10 minutes now. So look for the recording on Group Dentistry now, and everybody have a safe rest of the week.
Thanks so much, Bill.
Thanks a lot,
Bill.
Bill.
Thanks, everyone.
Appreciate it.
Thanks, Bill.